again for being here on this Saturday. So I really like these Saturday events. Markets are closed, so we're not going to be distracted. So we're going to dive into how to, trade the uncertainty of markets, selling options for income, profits, and hedging. Kind of a 7-step plan, to help guide you through kind of my process that I use. So that being said, let's get going. So a little bit of background on myself. I started my trading journey back in the 80s on the oil side, and was fortunate enough to get a job with an oil trading company. Actually, it was a refiner that had, trading to supply the refineries and things like that. It was called Coastal Corporation out of Houston. And they actually had a training program that they had put you through. So I went through that, and it was great. They'd send you to the refinery, kind of learn the refining process, spent a few months down there and just kind of learn the whole concept and fundamentals. And then went to work at a company called Trans World Oil, which at the time was the largest oil trading company in the world, along with Mark Rich and Fibro. So that's where I really got a lot of experience in just all the different trading markets, not only on the oil side, but we were in all the futures, foreign exchange, et cetera. So ended up in Bermuda for about 17 years, ran the trading group, international trading group for 10 years, and that's a picture of me back in the mid 80s. So that's where I started first trading options back in 1987. We started selling premium on cargoes of crude oil. So, that's where my option trading journey started. And that kind of fits in here to what we're going to talk about today is, selling options for income, profits, and hedging. So again, thank you so much for everybody being here. So the following presentation is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. Now, trading is really a business of probability. So to be a successful trader or investor, it really comes down to controlling your risk. And that's what's going to, win the game in the long run for you. So by better knowing and understanding how to manage and control your risk, it's going to make a dramatic and positive difference in your overall trading or investing performance. And the best way to achieve this goal is through the use of options and option spreads, in my opinion. So, why use options? Well, they offer you a really unique pricing structure and the capabilities to, using option spreads to provide you really controlled risk for higher probabilities of, tilting those probabilities way in your favor. So when used correctly, option spreads are going to help you to give you more defined trading risk, so you can totally define what your risk is going to be, lowers your capital at risk, provides greater trading leverage for greater returns, and will offer you an unmatched hedging advantage for your trades. So it really comes down to just then understanding the option spreads and how they work. So first step, though, in kind of this trading kind of 7-step process that I will talk about is knowing exactly how does option pricing works. And by knowing that, then you're going to be able to better maximize your trading profits when you're using options. So now when trading options strategies designed for income and profits and hedging, the most important option factor that really makes these strategies work is time and volatility and the impact that they have on the price of your option. So, when we look at time value, that's the component of time or time value. And we also refer to that as extrinsic value of your option. So it's the premium that the rational investor or trader is going to be willing to pay over its current exercise value, that intrinsic value, based on that potential to increase in value before expiring. So the change in this value of an option based on time decay, we can actually measure it by the Greeks. And that's what's really great with options. We have these various Greeks like theta, delta, vega, and we can measure certain things when option price moves up or down or implied volatility changes. We can measure how that's going to impact the price of an option. Now, when we look at option theta, it's got characteristics to it. So it's going to be either kind of a positive character or negative impact on your underlying security. So for example, if you're long a stock option like a call or put, that's going to have what we refer to as a negative theta value. So basically, if the underlying security is not going anywhere, you're losing value each and every day as that expiration date comes near, and eventually that goes to zero. Now, the other side of the coin is if you're short a stock option, so if you're short a call or short a put, that actually has a positive theta value. So that if the security goes sideways, you're gaining value. And that's one of the big benefits when we're selling options, or kind of option spreads that have that selling side component to it. Now, when we look at the volatility component, what that is the implied volatility is a part of your price, and it's what basically the marketplace expects the stock price to do in theory. So it's simply the amount of a stock's price fluctuation without regard to direction. So it's kind of a forward-looking measurement that's going to yield a theoretical value, for the option based on the option pricing model. So the option pricing model, a lot of times you probably heard it's called Black-Scholes model. So you put certain inputs in and it gives you your kind of option price. So, but in theory, this, when we're using these stock option models and looking at implied volatility, in theory, a stock should end up within one standard deviation of its original price 68.2% of the time over that option cycle. So that's kind of the theoretical, standard deviation. What that means as far as a normal range. And then we can break that down by days into expiration. So by knowing this probability of your underlying security finishing within a certain range at expiration becomes key to then determining what options you want to buy or sell, and then what option strategy to implement. So the next thing is when we look at the value of the option, it basically comes down again to your time component, time value, times the implied volatility, times the underlying security value, or that intrinsic. And once you know these variables, then we're going to be ready to price out an option, and then know what option premiums should be and what option strategies we may want to use. So here's a good little table to kind of run through how this flows. So if you look at the option values, again, time value times the underlying implied volatility times the security value gives you your option premium. So we'll keep this intrinsic value constant so we can just see how time and implied volatility affect the price of your option. So, every week we have weekly options, and on Thursday we get a new series. So that's the other great thing with options. We've got a lot of different expiration series we can use and play with. So the first day, though, we've got 100% time. In this situation or example, I put implied volatility at 300. All right, so we kept that at constant. So it gives you a price of $300 on that option. Now, when you come back in after the weekend, Monday, we've had that time decay cut in half. So it's eroded already 50%. And even if that implied volatility was to spike up to, let's say, 800, you can see that your premium only is at $400. So that's going to, really impact the price of your option, is time and implied volatility. And at the end of the day, at option expiration, both of those components go to zero. So that's what we can take advantage of when we're selling option. We're selling time and volatility. And the big benefit is that we know that those two option pricing components go to zero. So if we use the appropriate strategies, we can take advantage of that option pricing. All right, so that's kind of how that works. Now, the next thing is, how do you trade time? So we can actually trade time by selling time, and that takes advantage of this option time decay, or theta. The other way to think about it is like an option is kind of like a coupon that you're going to get at a store. So it's got a kind of redemption date that you have to use it by. And if you don't use it by that date, it's going to be no longer valid, so it expires worthless. And so an option is kind of like that. So when we look at option theta, again, it doesn't remain stagnant. So it's going to increase as expiration draws near and decrease as the options go more in the money or out of the money. So these are, kind of a moving part. So the impact and the effect of the option theta actually decay really gets going the last 30 days. So that's where it really impacts the underlying security value of your option, is that last final 30 days. So here's a good illustration of how this works and flows through. So if you went out and looked for, an option 120 to 90 days out, you're going to see that the option theta is a very small, little decrease. So it doesn't impact the price of your option as much. But once you get to that 30 days out, that's when it really starts to accelerate. And then we've got those weeklies that we can take advantage of to play this accelerated theta decay and volatility that will eventually crush and go to zero. So that's the sweet spot. Typically when we get about 20 days out, that's where you can really do a lot of great things, either selling options or having option spreads that combine that sell side component. Now, when we look at options, again, it comes down to trading the probabilities. So let's take a look at what that really means. So when we look at the broad markets, you probably notice that they'll have a tendency to have maybe a 2 to 3 week cycles, and then we'll trade in a sideways channel 70 to 80% of the time. So, we may get a big price move up or down, but then eventually things cool off and we kind of cycle turning sideways. So it's based on this sideways price movement that out of the money option buyers are going to lose approximately 70% of the time. So those options expire worthless. So the market makers, professional money, they know these statistics, and so therefore they want to tend to trade from the sell side because the probabilities are going more into their favor. So this is kind of professional money. So you need to start thinking like these market makers, and it all comes down to the math probabilities. Now, the market makers, they use mathematical market probability statistics for pricing the movement of your option into its expiration. So by knowing the probability of your underlying security finishing within that certain price range is going to be key to determining then what options to buy or sell and then which strategy to use. And these statistics, they forecast how likely it is that an option will fall within a certain option pricing series range up or down by that expiration date. So it's this forecast that we can use to kind of forecast price up or down, and we refer to this as the implied expected move. So this implied move is basically an estimation of a plus or minus 1 standard deviation more move over the security's lifetime. So when we look at it, we can see this distribution curve, kind of how it works to kind of visually see the impact. So this is a normal distribution kind of bell curve. And here, if you're selling options out of the money, 1 standard deviation, you're going to start out with an 84% probability, theoretically, chance of winning. So in this example, if you look here, XYZ is trading at $500, and it's got an implied expected move that we're looking at about 4%, so you go up to 520 or down to 480. So this implied expected move up or down, that's 1 standard deviation. Now, when we look at option delta, it's like think about one option contract's equivalent to 100 shares. So if we've got 100 shares, that would kind of be equivalent to a delta of 100. So we start with 100 as the max delta, and then if you see this outside point here, I've got it kind of highlighted there at 15.9. So refer to that like a 16 delta. So that means that this point here is like the 1 standard deviation outside point, about 16 delta. And then this price here is about a 16 delta, minus 16 or plus. So if you take that delta of max 100 and you take that delta of 16, you can see that the difference is 84. So that's your kind of probability that price will be below 520 if you're selling that call option, or price will be above 480 if you're selling that put option with a 16 delta as your short strike. So that's one way you can kind of theoretically get your arms around it. And if you did, like a 2 standard deviation, that gives you about a 95% probability. If you're selling out here 2 standard deviations at your short strike, you've got about a 95% probability that price will be below that short strike that you were selling, or if you're selling a short put, that it will be above. So that's how we can play with these statistics and use those to kind of help us navigate the markets by understanding how they work and then applying them to the option spreads that we want to use. So here's another example of option delta and the probabilities. So we're going to use delta as a great way to quickly assess, probabilities. And so in this example, this is a option chain on Apple. So you can see Apple here trading at $190 basically. And if you look here, this is Thinkorswim, and right in this little window here is a really little great tool. So this shows the implied volatility, probability out of the money delta. So if you look at Apple trading at $190, 28 days to expiration, look down here at the strike, $190 right here, you can see that it says the delta is 0.52. And then the probability, this is probability out of the money. So So basically, the probability that it'll be, at 190 or below or above is 50-50. So basically, you look at that delta as 50. So there's a 50% probability that the price will either be below 190 or above. Now, when you go further out the chain and look at that 215 strike, for example, you can see that the delta on that is 0.05. So the way to interpret that is that that if you were to buy options, that $215 strike with 28 days till expiration, theoretically you've got a 5% chance that it'll be at 215 over that lifetime. Or the reciprocal of that is your probability out of the money, that there's a 95% probability that price will be below 215. So that's how we can really use and judge, is it a wise thing to buy way out of the money calls, or is it a wise thing to buy closer in and things like that. That's how we can assess the risk of doing certain different trades. So using that option delta is a really great handy tool. Now, this probability analysis is going to provide you a very useful tool to determine your price targets to trade against. So, we always look, whenever we do a trade at Power Cycle Trading, we always first set up, okay, where's our price target? And then we can kind of back into the type of strategy and determine, what strategy to use, to get to that price target, and what return on that our risk that will provide us. So that's what we can use the option platforms to help us to kind of determine this kind of forecasting. So it's based on these probabilities that you'll see that, again, about 70% of options that are bought expire worthless. So again, based on these probabilities, it's always a good idea as a trader or investor to consider not only just buying options, but selling options as well. So by adding option selling strategies to your trade portfolio, it's going to make a huge difference and a positive difference in impact to your trading performance when you use these type of strategies correctly. So what really helps win the race is incorporating high winning probability option strategies that have that sell side component, and that's going to really help you, to produce income, profits, and a great way to, hedge and manage your trading risk. So the next thing, let's take a look at it. What I refer to as what's called the market maker secret. It's what they don't want you to know. So, here's an example to kind of illustrate this kind of situation as far as forecast pricing, outside options, way out of the money. So, imagine you're bullish on Tesla and it's, trade about $198 where it's currently at today. So now as a beginning option trader, you might be really tempted to buy calls like 21 days from expiration with a strike price of $285 that would cost 16 cents, or that'd be $16 per option contract. So why would you do this? Well, it's all going to be based on the math. So let's take a look. So here's an example of Tesla. Tesla's, trading right there, Friday going out right at 298. So we're going to look at, an example of if you were to buy calls that 285 strike out of the money 21 days out, and see what the impact will be, what the cost, what the potential profit, and what the probabilities of getting there, would be in your trade performance. So let's say you go out and you purchase just 100 shares of Tesla, so make it equivalent to one option contract. So you buy 100 shares of Tesla at $198. That's going to cost you $19,800 that you're going to put out for those shares. But think about it, if you took that same $19,800 and you were buying options that cost $16, you could literally buy 1,237 contracts of those $285 calls. That would actually control you theoretically 123,700 shares. So that's really kind of eye-popping, but that's the leverage that options can provide. And that's a game that some people like to trade, getting those way out of the money options, but there's a lot of risk to that. So for example, imagine then Tesla does hit that 285 within the next 21 days, and those $285 calls they went from $16 per option contract, and now they're trading at $116 per contract. So you would literally then be up $100 per contract, And on those contracts, 1,237 contracts that you bought, that would give you over, 123,000 return on your investment in less than a month. So that is actually, how options can be levered to give you these eye-popping type returns. So at first glance, this kind of leverage really is awesome. But, let's don't let this glitter fool us, because not losing money is just as important as making money when we're trading. So if you want to stay in the game, you really need to control and manage that risk. So the one problem, though, with this short-term out-of-the-money option buying is that you not only have to be right about the direction that the stock's moving, but you must have the right, you must be right as far as the timing of it too. How long does it get there? Does it get there at all? So this really then ratchets up the degree of that difficulty to make that profit. So to make a profit, the stock doesn't just need to go past the strike price, but it also has to do it within a certain defined period of time of that option series that you're using. So in this case of this $285 calls on Tesla, you would need Tesla to go to 285 within 21 days to make your profit. Now, this kind of dual objective of having to be right on direction plus timing, that really makes it kind of lessens the probability of your option trade being a winning trade when just buying options. So it really ratchets up that risk. So, my trading kind of profits formula, though, is more so based on looking for trading high winning probability type trade setups with type risk management, and not being totally speculative like this. So we'll go through how this is really high speculation. So in this Tesla example, you're wanting Tesla to move more than be over 40% in 21 days. And that would be like a 3 standard deviation move. I mean, Tesla can have those moves, but theoretically, that's a very, very, very risky. You're really pushing the envelope to try to think that you can get 40% or 3 standard deviations. So not many stocks can do that. So in all probability, the stock would not reach that strike price and the options would expire worthless. So based on the probabilities, using your standard deviation kind of forecasting tools, there is a less than a 2% chance that Tesla would reach 285 by expiration. So in order to make money on that out of the money options that you're buying, you need to be very precise or lucky about that market direction and timing. So you might get lucky 1 or 2 times, but over the course of your trading, you're not going to stay in the business very long if you're just kind of doing those kind of plays. So you can see this kind of illustration of your standard deviation. So this is like 1 standard deviation right here, and that's a normal, a normal range. So from a price point, from the upside to the downside, that's what we call 1 standard deviation. That would be a normal price movement. Now here's 2 standard deviations. You're starting to get really extreme out that curve. And here's 3 standard deviations. So that Tesla trade was almost like you doing 3 standard deviations. You're buying way out here. So the chances of that happening, that you get there and you make money, is very small. And that's why when you look at $16 per option contract, you're taking a lot of risk, even though it does sound great because it's cheap, but that's because it's really risky. So here's the option chain to kind of illustrate that with option delta. So here's Tesla, trading roughly at 298, 21 days expiration, that 24 March contract. So here's the strike price, 197.5. So that's like a 50, 54 delta. So those options are going to cost, if you bought, the 197.50, that costs you about $11.50 basically. So $1,150 for 1 contract. But then if you're starting out and you look down here and you see that 285 strike and you look over, wow, man, 16 cents, $16, I can load the boat on that. And with that example, I could buy over 1,000 contracts. But then look at the delta. So if you don't understand delta, you're missing the boat here. So that says up 0.2. So there's a 2, to interpret that 2% probability of price getting to 285 over the next 21 days. Or the opposite probability out of the money is 98%. So you're taking a huge amount of risk to get to that price, even though it looks really juicy and tempting, when you look at that. So, when you look at it, being close means no cigar in this example. So, imagine that Tesla, was able to get to $238 in 21 days. So you were right on the direction, you got that right. But since you were wrong about how far it would go within a specific time frame, you're still going to lose. And losing those trades and that kind of potential loss is always going to be outright painful. So here's just a more illustration on an option platform of what that looks like. So here's the buyer of those Tesla 24 March 285 calls. So if that buyer, he bought 1,237 contracts, and he paid 16 cents or $16. That's cheap, but he's still, here it is, 238 at expiration on those options expiring on the 24th. So he just lost his whole bankroll, trying to speculate on that. So he's down over $19,000 that he put out. Now, the other side of the coin, though, is that market maker or whoever sold those options to him. So they, walked off with the other side of that. So based on this trade example, a better goal for every trader is to look to select trades based on what's going to give you the most consistent positive returns and not that one-time big winner. So, consistency is derived from making high winning probability trades based on a good reliable data and the statistics. So where there's that big disadvantage, such as the one you saw from the option buying scenario, flip the coin the other way and you can see the opposite advantage for the seller. So in this example, the seller of those options has a huge advantage over the buyer. He has that statistical advantage in his favor. And that's what the pros know and the market makers, so they take advantage of these stats. So as a seller, all the things in that Tesla example are the same, but in your favor instead of against you. So if you were to have sold those 285 calls to that buyer at $16 per contract, you were going into that trade statistically with a winning percentage of 98%. So, you would have then made, $16 on those 1237 contracts. So you would have made over 19,000, and you made that on a 98% probability of winning. So that's what the professional money's looking at, and that's why they tend to be on the sell side. So what I love to do is combine, selling and buying to construct spreads that you get the benefit from both the kind of the buy side potential levered returns, and then you can hedge a lot of that risk by selling, having the sell side component to it, and that makes an option spread. So here's the opposite of it. So that Tesla, the market maker that sold it, he sold those contracts and he brought in $16. Well, he just walked away, with a big fat over $19,000, and he was doing that with a theoretical probability of 98% probability that price would be below that at expiration. So those statistics can really make a big difference if you understand, how to use it, and then the appropriate, correct option strategies to apply. So then it comes down to, okay, when is it time to sell? So this is another thing. So, I've always been obsessed with kind of cycles and market cycles. So I've developed a number of different really good tools to kind of help navigate, when market cycles turn up or down. And so two tools that I use is one is I call a cycle reversal indicator, and the other tool that's a really good complement to add to it is what I call the extreme range band indicator. So here's an example of how these two tools combine, and then I also add my momentum can really help you pick when it's time to sell options or buy options. So here are a couple examples. So this is on the S&P 500 SPX. So this is a daily time frame, and these bands here are extreme range bands, which are based on average true range. So this blue one is 3 ATR away from the mean, which is basically this 20-period moving average. So when you get to this 3 ATR, you're getting very extreme and what I call stretch. So what tends to happen is you get too stretched from your moving average, then you're going to typically have a reversion back to that mean, and sometimes it overshoots. So when you get stretched up here, like here, this signal pops up, and you can see below is the actual indicator. So it's way overbought. It's overbought. This is actually an overbought, oversold indicator as well. So it's overbought over 90 percentile, but then the indicator crosses its moving average and gives that signal right there, that purple arrow, and that's a really good indication. Okay, that's a good time to sell. So by using this, you can do a lot of different things. You could sell out of the money bull, bear call credit spreads, up and out of the money like that. So even if it does turn sideways, you're still making money. Or do other strategies for that mean reversion. But that makes it a really good tool to kind of pick off when it is time to sell or buy. So that's an example of a daily cycle high reversal on the S&P. Here's an example of QQQ, the NASDAQ 100, and you can see up here it has multiple cycle reversals. It shot through that 3 ATR here, gave us a reversal. So it's kind of transitioning, trying to figure out, okay, should it move lower? So here again, you could sell out of the money. There you could sell out of the money, and see it didn't go anywhere. So it just churned and then finally started coming off. So really great tool to kind of navigate and tell you when it's time to sell or time to buy. So that's an example QQQ. Now here's an example of the natural gas UNG on a weekly long-term basis. And so setting up, there are three kind of things that I think look really interesting right now. One is natural gas. And so that's based because the weekly long-term time frame, you can see natural gas has had this huge sell-off. And so back here in June, we had a cycle reversal from that upside, and look, mean reversion. We had to move back up, and then look at this huge move down. We finally, just a week ago, had a cycle reversal on the weekly long term, and it's extremely oversold 10 percentile, been oversold for almost 3 months. So this gives you a really good potential here for maybe bigger, more upside on natural gas. So that's one play that we're currently in and using to see if we can kind of work this trade up. So here, let me just kind of pull up the chart and you can better see it. So if we look at natural gas as one play, I think has more potential upside, and it'd be one that we'll see if we can get a little bit of longer term movement for it. Now it's not going to go straight up, but it's going to back and fill in. But the point is, the potential is for a more of a bigger trend up. So you can see extensive move down. And then when we look at the weekly, this is where we go into when we have something that has a lot of pressure to the downside or upside. The weekly long term tells you when it's starting to bottom out. So here you can see it starting to bottom. You can see that cycle reversal there, and we're starting to base, and this has potential for a bigger trend up. So like the looks of that, and that's a good example to kind of illustrate the when you get too overdone to the downside and too stretched. So what tends to happen, you get exhaustion of sellers, okay, and then finally that reverses, or you get an exhaustion of buyers in this example right here. So natural gas had a huge run up, but then finally ran out of buyers, so exhausted and came back down. So it's been a great tool for kind of showing us when it's time to buy or sell. So that's another example. UNG, and then here's one of Tesla. So you can see, remember Tesla had that massive sell-off down under, right to 100, and then on the weekly long term we had a cycle reversal, and then it's been up ever since. So this has been a really good tool. So see how oversold it was for a considerable period of time, which you can stay oversold or overbought, but then it reversed here, and we've been on a trend. It's gone from basically 100, and now it's up close to 200. So it's a great tool for managing that. Here's a cycle reversal to the downside. So this has been a great tool that we use kind of to give us that navigation. So the next step is then, okay, let's take a look at the strategies and select the right strategies. So let's take a look at the ones that you can incorporate that kind of have that sell side component to utilize. So the major goal to me for every trader should be to select trades that are based on what's going to give you the most consistent positive returns over time, and not always looking to hit that home run. So I kind of look at trading as like hitting singles and doubles, and occasionally you get that big move home run. but to stay consistent with a nice positive equity curve, it's more controlling your risk, kind of singles, doubles, and occasionally you'll get one that really runs. So by doing and knowing, how to kind of make these consistent trades, you need to know and understand what strategies are out there available to you, then how they work, and then select the one that's going to be best suited for the market environment and your kind of trading kind of profile, your risk profile, and the time you have to trade, your capital account. So all those things go into it. So let's take a look at the kind of strategies that you can utilize to take advantage of selling options and the strategies to use. So first off, there's the vertical credit spread. So really popular, kind of selling strategy for bringing in premium for kind of income generating. Then there's the strategy, what we call the iron condor, which is a combination of two different vertical spreads, credit spreads. And then we've got another really great strategy that I like to use quite a bit, and it's called what we call the long condor. So totally different from the iron condor, and I'll show you the difference. And then kind of what we have is what I refer to as opportunistic hedging, using options from the sell side. So we can really hedge out trades by knowing how to do it, selling options. So the number one trade kind of strategy, very popular, is the credit spread, a vertical credit spread. So basically, there are three types. You've got the bear call credit spread, you've got a bull put credit spread, and you've got then a combination of those two, which creates what we call the long iron condor. So when we look at a bear call credit spread, it's going to be one that you're going to want to use if you think the market's going to probably go down. So your kind of overall picture is it's going to go down, but it doesn't have to go down. It can just churn sideways, or it can even go up a little bit, and you can still make money. So basically, you're selling a call while at the same time buying another call with a higher strike in the same series or same expiration series. So the same, monthly or weekly series. Now, the concept is your maximum value of your vertical spread is going to be equal to the difference between the two strikes. And the seller of the credit spread will then have a limited profit, but also a limited loss scenario. So depending on which strikes you use, you're using and utilizing that advantage of taking, selling time and bringing in that time decay, which is what really helps the position of profit. So that's what it, really helps when you're just looking and having something churn. So you're just kind of waiting. So I've got a question here from Tim. It says, do you wait for an extra confirmation signal after the cycle reversal is initially triggered, or do you instantly jump? So good question. So when you're doing credit spreads out of the money, you can just go ahead and put the trade on. These indicators have been just really high probability, very accurate. So the tendency is, you hesitate, but just from going back and looking, and the experience is that if you just sell out of the money credit spreads, it's typically a good trigger for doing it right away. So, but we'll use momentum as a confirmation, but you can just go ahead and execute the trade if you're selling out of the money type trade setups, because it could churn sideways for a while. So we look back here, for example, let's just say QQQ. I was looking at that. Hold on, let me get my other chart here. So I'll put this on a daily. So what you need to think about is, okay, so let's say we get so if you get to the 3 ATR, that's the really stretched extreme. So when you get to 3 ATR and you get the cycle reversals, then you can go with it. So see, that's at the 3 ATR band. So just kind of envision if you get up here, for example, right here, or even here, and then you sell an out of the money spread, especially when you get to 3 ATR. That's why I like it. 3 ATR is very stretched right there, super stretched. Okay, so think about it. So when you get there, and let's say you sell out of the money, so you don't sell right at the money, you don't buy puts, you just sell something out of the money. So even if it churns, you can see here it churned for a couple days, and then finally had that reversion. Here, if you sold out of money, here it kind of churned and then just reversion, but it didn't go anywhere, right? It just went sideways, but that's okay. You still made money. And even if you did it on the downside, here's if you sold, and you get to the 3 ATR, here's if you sold puts or bull put credit spread out of the money, goes up. Here's if you sold a bull put credit spread out of the money, it goes up, churn sideways. So it's a really good tool for, kind of picking, bottoms that you can then sell out of the money against. So it's high probability type of indicator tool to help you do that. Okay, so that's the key concept there. So, the maximum value is your vertical spread width, and then the credit brought in is your potential profit. So the bear call or bull put credit spread can make you money over time, even if the stock stays stagnant, like I just showed on that kind of chart. So here's an example of a vertical call credit spread if you're looking at setting them up. So this would be like if you sold a call here. Okay, so this would be like the 1020 call. This is on the S&P, or this was on the NASDAQ 100, I think. Okay, so let's say you sold that call there, that 1020, and then to cap your risk in case you're wrong and it goes up, you're buying a call above it. You're buying that 1030. So if you look at the spread width, that's a $10 wide spread. So 1,000, you're looking at a $10 wide spread, which would be times 100. So the spread width is 1,000, and your credit, if you did this and you sold that call right there, that's $200 premium brought in. And so the difference is your risk is $800. So this is what we call a negative risk ratio. So you're probably thinking, well, why in the heck would I ever risk 800 just to make 200? And this would be, if you kept that money, it'd be a 25% return, because these are what we call probability trades. So this was like selling a 20 delta, so let's say the delta here was a 20 delta. Okay, so theoretically, max option delta is 100. So if you sold that 20 delta, you've got an 80% probability. Theoretically, the price will be below that short strike there of 1020. So by going into the trade with an 80% probability of winning, you're not going to get the biggest, return because the risk is less. Now, if you go back to that Tesla trade and you were, sold that or bought that delta of 2, well, those were $16, right? So that was cheap. That was a reason for it was cheap, because that was a very, very extreme out of the money. So these are probability trades. So high probability, low probability, looking at Tesla. So that's why you get those kind of stats that are what we call negative risk ratio. So that's typical of a credit spread. And your typical return of a credit spread, if you're going out around 1 standard deviation, will be about 20 to 25, maybe 30%. But it's a probability type trade that you're going for. So here's an example. This was like Netflix, and you can see it came up to that 3 ATR, and then this was setting up a credit spread to take advantage of it. So here it was, and then sold out of the money a 20 delta short strike right around here, and then just play for mean reversion. So even if it churns sideways, you're still having a high probability that this will be a successful trade, marrying that or complementing with the tools that we use. So here's the trade setup, was executing this trade to do a bear call credit spread, and this was selling the 315 call, buying the 320. So we're short the 315 call here, and then above it bought the 320 to cap the upside risk. So you can see this was done for $5 wide spread. So your spread width is $5 or 500, and your profit potential would be that credit of 95. So you've got a potential to make $95, and so your risk is the difference. Okay, so if it closed where it did down here, you keep the full $95, and that will be your your return on that risk that you would have here of what is that, 405. So let's see, make sure I'm doing that right for you. So if you ended up making the full 95, if you didn't cover, let expire worthless, you're making $95 on the risk of 405. That's well, I'm doing that wrong. So return about 23% right here in 3 days. So that's a credit spread. So, again, it's a probability trade that you're going into. So look back at the chart here. You saw that 315. That's about a 20 delta, 1 standard deviation out of the money. And so that gives you a good high probability trade going in. So that's an example there. Now, the bull put credit spread is the other side of the coin. So it's best used if you think the market's going to probably go up. So it doesn't have to go up. It can go sideways to up or just stay sideways. But you think overall the bias is that it's going to go up. So basically, you're selling, a put out of the money, while at the same time buying another put with a lower strike in that same expiration series to cap your downside risk if you're wrong. And this is going to, also be taking advantage of selling time and volatility. So here's an example of, say, a bull put credit spread on Apple, and Apple is trading here at 157. So, this one was selling a short strike here. You're selling the put, short put here, the 149 put right there. So you're short that put 149. Okay, so you're short that put, but then to cap the downside in case it goes down, you're buying that put. So that's a bull put credit spread. Now the spread width here you can see is going to be $5 wide. So you sold that you sold the 149, bought the 144, so that's $5 wide, or $500 is your spread width, and then your credit you received here was $105. So that's your profit is your credit received. So your profit would be your credit received, and your risk is the difference, which would be 395. So negative risk ratio. And so your return on this one is, about a 26% return. So that's a common normal return. So that's what you're looking at when you do these types of credit spreads. They're a high probability trade, but you need to, have something to help you, with the cycles up or cycles down. So that's why this tool has been great for credit spreads. So the next one is and think about this. So if you're going into this trade with a high probability, so let's say you did that 20 delta, just kind of as a standard. So you've got a 20 delta. So you're going into the trade with the potential probability of 80%. Now think about it. So then if you go statistically, you've got an 80% chance to win. And then when you match that and marry that to a cycle indicator to pick off tops and bottoms or cycles when they're turning, that actually increases that probability even greater. So going back again to, QQQ or whatever you want, we can put in anything you want. Going back to that, if we're selling QQQ out of the money, for example, just on a daily time frame, and right here, you sold QQQ either. You could have sold it either, here, if you sold it out of the money there, 20 delta, start out 80% probability. But with this indicator tool, this thing is highly accurate. I'd say it's probably 80, 85, it's really accurate. So, just think about that, increases the probability even more. So let's see here. So there's just a lot of examples I could show you if we had time. We'll go through more if you have any options or anything you want to look at, we can. So the next one is what we call the iron condor credit spread. So basically, it's just going to be the combination of your bull put credit spread and the bear call credit spread together, and there should be equal distance between the strikes. Of your underlying security, and your expiration series should be the same. Okay, so basically you're short. You have two credit spreads and two option contracts that you're two spreads that you're putting together. So you're using the long iron condor is ideal for premium collecting, where you want to seek to minimize your losses. And it moves against you, but it's going to, again, take advantage of time decay and volatility and that probability analysis of if you're selling out of the money. So it can be, broken down and looked at and viewed as a bull put credit spread with a bear call credit spread. So if you feel the stock or security is going to trade in a tight range between two strikes, between two areas of support resistance and stagnate, then this is a great strategy. So, again, if you have some good tools that kind of can help you make that judgment call. So if you've got good solid resistance up here, and then you've got good solid support down here, then this is a great strategy that you do what we call the iron condor. So you sell, credit spread, a bear call credit spread, and a bull put credit spread to play that range, and you can increase your potential returns that way. And the other great thing is these are great for legging in and legging out. So you don't have to do it all at once. You can, if the market goes up, for example, and then it has a cycle, start coming off, so it goes up, cycles down, then you sell that bear call credit spread, comes back down, starts turning up, sell that bull put credit spread, and then you create what we call the iron condor. So a great way to leg in, leg out, and adjust your risk that way, and take advantage of, theta decay and volatility. So there's your structure, what it looks like. So it's a combination of two credit spreads. So this would be an example of short a call, long a call. So there's your bear call credit spread, and then short a put, long a put, and there's your bull put credit spread. So you've got those two. So, if you, let's say you make, $50 credit here, $50 credit here, you've got a total potential then to make $100. And let's say the spread width is 200, so you've got that, bigger potential profit, and then you can leg out. So let's say you got into the bear call credit spread here, comes back down here, and you say, okay, let's go ahead and take profit there. You can leg out, close that one out, and you're still in the bull put credit spread. You can go back and forth. So it's a really good way to play a range in a market and take advantage of, kind of range bound markets, which we've been in quite a bit actually. So here's an example of Google. This one we had on the sideways kind of price action on Google. So it was trading, you can see it had been in this range here, this upside range, and then this downside range down here. So kind of right in here, so you can see it had been back here trading like that range. So this was taking advantage of that kind of range in here. So the upside, downside, really good support right there. So when you have good solid support up or down, or resistance, this makes a good kind of setup for that kind of trade. So here's the trade setup, and this was then a combination. You can do it all at once or leg into it. So this was selling the 105 put short buying the 100. So you're short that 105 put, long the put below it. So there's your bull put credit spread, brought in $40 credit there. And then here's your bear call credit spread, was selling the 114 call right here, buying the call above at the 118 to cap that risk. Okay, so you have two different credit spreads on, but with this credit spread, you brought in a total of $90 credit, $40, and actually brought in $92 credit. Okay, so that's your potential profit, and this one ended up going out and making the max profit of $90. So 30% return in 13 days. So your downside is limited to the spread width less the total amount that you bring in. So that's the an iron condor. Any questions on any of this? I'd be happy to answer anything that you've got. Well, the ATR, average true range, it depends on the time frame that you're putting on your chart. So if I have my, if I've got a daily, that's the average true range is based on a daily. If I do a weekly, it's based on a weekly. Or I can break it down to time frames below that. So I can actually, another good time frame is the 4 hour. Let's see here, 4 hour time frame. If you're really trying to pick cycles, turning points even more accurately. So here's the 4 hour. Here's the cycle. Here's extreme range. I'm just happen to have this up on QQQ, but just think about it. So here's the 4 hour. So you sell a bear call credit spread up here. You sell a bull put credit spread down here. QQQ, anything that you like to specifically look at, we can pull it up. Here's SPY. Or let's say, everybody loves Tesla. Let's take a look. Huge option volume. So Tesla, if you're just, you could use this just for kind of even short-term intraday trades. So if you look here, Tesla gets up here to this a 4-hour time frame. You could just, pick things off, sell, a little premium out of the money, pulls back, buy it back, sell a little premium out of the money, pulls back, down. Here, sell some premium below, up she goes. So we can use it on any time frame. So that's how it's set up. Now, the next one we're going to look at is what we call the long condor. So this is a different animal from the iron condor. And so this is a great one because it's going to give you a bigger potential profit, but you're also got the credit spread side of it to kind of reduce your risk and give you more potential to take advantage of theta and volatility. And this will give you the positive theta return or positive theta. So what this is doing is combining buying and selling options. So it's going to be a vertical debit spread with the vertical credit spread. So, think about the iron condor. They both look the same when you look at the profile. They both look like that, okay? But the iron condor is going to be 2 credit spreads. So an iron condor would be short a call, long a call, short a put, long a put. Your maximum profit is your credit received, and this is going to be a negative risk ratio. So you're going to be actually risking more than potentially what you can make. Now, the long condor is a combination of a debit spread with a credit spread. So in this situation, we could have a long call, short call, so call debit spread, and then we add a credit spread, a short call, long call here. And what that does is it reduces the capital from the debit spread that we put up, and also increases our positive theta by selling the option spread there. And we've got a nice potential zone here for profit. And we've reduced the capital at risk, reduced our theta, and it's a great strategy. So it provides you a bigger profit zone, gives us positive theta, no time decay. These are really good for kind of 1 to 2 weeks out. So potential for high returns on very low capital at risk. So, when you do the iron condor, it's good for range bound, but your returns are going to be basically, at 40, 50, 60%, something like that. The long condor, 200, 300% is typical. So you can see this profile looks just like an iron condor, basically. So here's an example just of how this works. So this is, Lockheed Martin, for example. This would be if you just call debit spread. So you go out and you buy the 307, call right here, sell the 310 right here. So you've got a call debit spread. Now, if we want to reduce the capital at risk, increase our theta, so it's got a negative theta, we can sell an out of money bear call credit spread that constructs and makes the long condor. So that's going to give us less capital at risk, and also it's going to increase and give us positive theta from selling additional theta and volatility. So here we have the bear call credit spread to it. So it's very simplistic. So you sell here the 312 by the 315. So now we've got that credit spread added to it. That has a positive theta, see 67. So that offsets that negative theta. So you have either small positive theta, and you've reduced your capital at risk, and you still have a great potential for profit, more so than if you did a credit spread. So here's what this one would look like. So when you put it all, wrap it together, so you've got that structure. So now you've reduced your risk in this example down to $59, and you've got potential, if it goes out between your short strikes here of those spreads, to make $191, which would be a 327% return. And you've got this whole zone in here, but that's your max. So it's a really, really good structure. Let me get rid of erase that. So, look here, you've got that debit spread, and these are great for legging in, legging out. So we'll a lot of times leg these. So you might start out with a debit spread and then add the credit spread. So if you did the debit spread only, you've got the potential profit on that as a $2.50 wide spread. I should have done this ahead of time. Yeah, $2.50 wide spread, and your cost is 99 cents. So potential to make $151. Okay, and then the credit spread side, you bring in 40. So you have got the potential, to make $191 on that, which is a 323% return, versus if you just did the debit spread, and you've got the potential there would be $2. You've got a potential to make 150, 149 on that cost of 99. So you see your return is about 2 to 3 times more return on capital from adding that additional credit spread side. Plus, it gives you a positive theta. Now, the next thing that I love about selling options is to combine them and use them for hedging. So that's originally options were, created to hedge risk on agricultural products and bonds and things like that. So, if you're not hedging, I always say you're an accident waiting to happen. So you need to understand how to hedge, and to do that, we use options and selling options to do that. So here's a good example to kind of illustrate what you can do. So this is one we had a short trade set up originally, and this was like a put debit spread. Okay, so then we adjusted it when it moved down hard. So what you want to do is, when you're trading options or trading in general, think 2 or 3 steps ahead. So don't think about just one thing. Think about like if you're playing cards or chess, you're always looking, okay, what happens if I need a certain card, or I need this chess move. If somebody goes here, this is what I'm going to do next. You're always thinking ahead. So you want to do the same thing with options. So in this example, we were going short. Okay, so we were thinking, okay, great, short. But what we want to do is also always try to enhance the trade. So we can enhance the trade by reducing our theta, and enhance the trade by reducing our capital at risk. And so that's what we can do. So in this one, we started out with a put debit spread, and then we were thinking forward that, okay, if it goes down to a key support level, let's see if we can adjust this into a put Condor to give us potentially no risk trade, okay, by doing that. So this is what exactly happened. So the 28th was trading at 365. Then the thing had a big, huge move down on the 1st. It was trading at 354 basically. So when it hit 354, we did an adjustment and we added to it. We were originally long a put debit spread like this. When it hit the 354, we did an adjustment and we sold a bull put credit spread. And that gave us basically, in this example, a free trade. So we were long a put here, short a put. Okay, and then when it hit down here, thinking a couple steps ahead, looked at our option analytics and could see that, oh wow, we could sell a bull put credit spread right here, and we could recoup the debit cost that we had from the original trade, and then have a free trade, sit back and see what happens. So here's exactly what we did. So here's trade 1, was long the 6 October 364 put, short the 360. So put debit spread like that. Okay, like this, long that put, short the put. Okay, so that cost $121 per spread. A good spread though. Potential $400 spread width, less the cost of the trade. Theoretically, if it closed here or below, we make $279, 230% return. Really nice. It's good trade setup to start with, but thinking a couple steps ahead. Okay, what if we get that move down? So what we'll typically do is we'll take some partial profit and then adjust the balance. And so that's what we did. So on the trade 2, on the 1st, it was trading at 354. So sold the same series, the 354 put, bought the 350, brought in $141. Okay, so that just absorbed that debit cost there and actually gave us a credit. So in this situation, if it went up or went down, we still make $20. But if it goes out anywhere in the zone, we've got the potential in this one to make max profit of $420 on 0 risk. So really a cool way to trade and kind of lower your stress as far as your trading as well. So here's your potential max profit. and credit of 20. So that's what you're looking at. We've got currently one that we're still in. I can pull it up real quick. We did something similar to this not long ago on XRT. And so we're sitting with a long call Condor on XRT. I'll bring that up. So this one has a really nice potential. And then if we don't get it right, we're still going to make a credit that we had set up on the trade. So I'll just show you real quick. So XRT, we've been in this one for a while, and we'll see what happens. But right now we got a look cycle reversal on the daily, so you could have sold a bull put credit spread on it. But we've been with a what we call a calendar, and then we adjusted this when it broke below 66 to a free trade, what we call a free trade, by doing this Condor structure. So what we have here is a long Condor, and we were able to turn this into just doing it for a credit of $17. Now this was up $40 on Friday, and then things went up, but we'll see. This thing could come back off, and it doesn't matter because we're locked in at least $17 profit, and then we took some profit on Friday of $40 on zero risk. So that's an infinite return. So you can see here, this is basically a put Condor. So we're long that 66 put here, short the put here. So short the 65, 66, 65, and then we shorted the 64, 63 right there. Okay, so we've got that zone, and we've got this for 17 bucks. So if it was to go up, which it's doing now, we still make 17. If it was to go past our area there, we'll make 17. If it goes out in here, this has potential to make over $100. So this would make $117 on zero risk. So these are great little tools, strategies that you can incorporate, to reduce your risk. And in this kind of market, anything that can help you reduce your risk is definitely worth doing. So those are a couple examples of their different things, the different approach by incorporating selling options with buying options, or just selling credit spreads and things that you can do there. So if you'd like to learn more on how to master these kind of selling options for income profits, I'm going to be doing a workshop next weekend just strictly on these types of strategies. So it's going to be next weekend. We'll start the 11th. Part 1 will be 11 to 2 p.m. Eastern. Then we'll follow up and finish up on Monday, 4 to 6. And I've got a great package. Let me go through the details of it. Let me get the link. So this will be $197, and you're going to get a great bonus package that comes with this. And all these tools and indicators that you get are yours forever. If you lose your login for your membership, I'll go through everything you're going to get. So use this link here if you'd like to participate, and it should be able to click on it and make sure it works here. Hold on, come on, baby. So it should pull up this payment link here. So good. I want to double check that. So this will pull it up. So you can just use PayPal, credit card, whatever, and this will, be everything you need here. So if you want my trading indicators, you can also, get those included here if you want to add those. So some people were asking about the indicators, the momentum, things like that. So you can also add that if you want. So that's the link there. Just go ahead and use that. Put it in one more time. So you should be able to click on it or copy and paste. So let me put it one more time here. So that's for, if you want this package, and we'll go through it, and then we'll go through all the bonuses and take any questions and go back through examples if you need. So this will be start next weekend, 4+ hour workshop on these type credit spreads. We'll go through in a minute exactly what the course will cover, but I'll go through the bonuses first. So with this course, to make you, hopefully successful with it, I want you to have these tools. These are tools that are going to help you with your trading in general. So you're going to get, as a bonus with the course, you'll get my cycle reversal indicator. If you go to my website, it's $197 on the website, but you're going to get this as a bonus. Then you'll get the extreme range band. So that's on my website, 197. Another really great kind of a course that I do, and then we use for all of our profit targets, our defense targets, is what I call price target mapping, which is based on Fibonacci moving averages and standard deviation forecasting, things like that. So you're going to get that with it as well to help you establish targets for profit or defense. So that's $397 on my website. Then to give your additional support, you're going to get a 30-day trial membership to my trading club, which gives you access to my trading room every day, our Q&As and some other stuff that we'll go through. So $97 a month if you plan to stay on. It's $97, or you can do annual membership. Then we'll do a follow-up set Q&A, which will be live and recorded, so additional support there. And then another little really good option course on my option trading tutorial on the Greeks and standard deviation, things like that. So total course value over 2,400. So everybody here today, 197. So it's just powercycletrading/sell1, or click on that link and sign up, and you'll get started. We'll get you the indicators next week as soon as we get those out. So the other package, though, if you want more help, kind of mentoring in your trading, I've got a trading alert service that I've been, having for a few years now, which has done really well. So you can have access to this if you'd like to kind of get this as an additional bonus to the package. So with this package, this is $597. Let me give you the link and I'll show you what you get out of this one. This is with my alert service to go with this course and all the indicator bonuses that you're going to get. So use this link here. And so with this one, you get my 4 trade alert services for 4 months, plus the trading club for 4 months, and everything in that course package 1 at $197. So the alerts that I send out, it varies on, what the market's, giving us. It might be, you might get a butterfly, or you might get a long condor, which we'll discuss. The other alerts that I send out, we do a lot of calendars and calendar diagonals, breakout reversal credit spreads, alerts for that, and selective earnings trades when those come up. So there are 4 different types of trades that you might get, or actually more. You could get a butterfly, a long condor, a calendar diagonal, breakout debit spreads, credit spreads, earnings. So it covers a lot of different things that the market's given us as far as, the market setups at the time. So with this service, you'll get all that, 4 months to the alerts, 4 months to the trade club, and everything in that course package 1, the indicators and the bonuses. Now, the 30-day trial membership, you can start that whenever you want. And if you do the alert service, you can start and stop this whenever you want to. So it's 4 months. So if you, go on a vacation or need to stop it, you can start and stop and still have your time. So with this one, anywhere 10 to 15 stocks, ETFs, do a lot of ETF type trades over the course of a month. And so again, you're going to get breakout reversal, credit spreads alerts, calendar diagonal alerts, butterfly, long condor alerts, and earnings. So with this comes, I give you a trade guide. So typically, always an option strategy to use if you want to use it. Some members do their own thing. The trade setup videos for that after the trade is put on that day, I'll do a video update to kind of go through the trade, why it was done. So these are listed and archived. Then we do a weekly Q&A every week, usually on a Tuesday. So I have that on for 4 months. And then these are also recorded. I do a video newsletter. So you'll have that for the next 4 months, every day after the close. In my trading room, virtual trading room, coach room. So access to that during the week, during the trade week. And then 60% discounts on anything, software, courses, additional stuff on my website. So you get 60% off on anything on my website. So that's a kind of short go through there. Now the service, summary of this, since I started, the first service I started was the breakouts back in May of 2018, and through yesterday, we've had the total closed out trades, 580 trades closed out, 438 winners, 32 break evens, 110 losers. So really high percentage winning percentage. I try to really make high, winning type percentage trades based on my trading system and the option strategies that we use. And so really go for that kind of high win. I, try to limit losses as much as I can for, my members. And now these are unaudited, but that's a summary of what you would be looking at as far as the combination of all four of those services together. So here's just a little nice thank you note from one of my members, Pam. She said, just sending a quick note of thanks that you can maybe pass on to Larry for all his fabulous teaching through the years. I truly have enjoyed learning from him and the other traders in the trade room. I don't think there's a better trader in the world when it comes to option spreads and the other ways to do trades. So I really appreciate that from Pam. And that's what you're going to be getting in this course, all the different option spreads that we'll cover. And we'll go through that in just a second. So here's part one, where we're going to be looking at in the course. I want you to understand the Greeks that are really important to make these types of trades work, selling options and credit spreads, how the Greeks work to, give you that information you need to, for adjustments, things like that. Option selling guidelines. I'll give you the guidelines that we want to follow for, setting up these trades. So it's kind of a set step guidelines that you'll get in the course. And then how option pricing works. Again, we'll go into more detail on option pricing, how that works. A really important part for any of the trades that I do or our members do is understand what I call, again, price target mapping and standard deviation to help us set up the trades, to give us profit targets and defense targets. And then what are the best markets and trading timeframes to use for your credit spreads? Then we'll go through how to use the cycle reversal and extreme range band indicator. So this will help you pick cycles, turning points up or down for setting your credit spreads and other type of trade strategies that you might want to do. So we'll spend time on that in the course. Very big part of the course is actually, understanding how to marry those tools to the strategies. And then we'll go in part two, the 4 best option selling strategies. So we're going to cover which strategy to use, when and how for income, and when and how to use credit spreads for income and hedging. So we're going to go through, when and how to step-by-step guide to use the bear call credit spread, bull put credit spread, and your iron condor. So extensive time there. So when to use that bear call versus a bull put versus the iron condor, which market conditions are best for these credit spreads to trade. So what are the ideal, how far out should you go? That's a big question most traders have is, how far out should I go, as far as to execute and enter these trades. And then I'll go through the 5 most kind of rules that I use for credit spreads. It's kind of a rule-based formula that I use for setting credit spreads based on 5 different steps. So we'll go through that. That'll be handouts for you as well. And then we'll go into when and how to use the long condor, which you will really, really like this strategy. That's the one that looks just like the iron condor, but a different animal. So when to use the long condor, not to be confused with the iron condor. So we'll go through the big difference there in the course and how to use the iron condor versus the long condor. So how to do that. This can deliver returns of 200% or greater. Positive theta, no time decay, which is also a big advantage. And so, you'll see the big advantage of this condor over the other option trade strategies. So we'll go through step-by-step guideline to set these up, combining the vertical spreads with the debit spreads, how that works, how to set them up, how to take them off, how to adjust. And so we're going to, in the course, I'll show you how to adjust to what we call a broken wing long condor or ratio condor. So another way to hedge your risk. And then we're going to go, part 3 is going to be a big part of the course, is just going to be dedicated to hedging. So hedging with options. So this will be a complete guide to how to hedge, from hedging a long stock to a call debit spread exact, and those specific steps involved there. And then we're going to go through how to hedge credit spreads and core trades, how, why, and when to use credit spreads to hedge a core position, and then how, why, and when to use a condor spread for hedging defense. And then we're going to go through 5 ways to hedge a credit spread. So if you've already been doing credit spreads, you're getting whipped up and down. This course will teach you 5 different ways to hedge a credit spread and still make money. So it's really cool, the different ways you can do. So then how to defend your stock portfolio. So I'm also going to show you a really good way if you do want to hedge a portfolio, which is called a protective collar. So if you've got a large portfolio or small portfolio and you want to hedge it, I'll go through and show you how to do that with what we call the collar. So it's going to be a great course and a lot of hedging in the course that you're going to learn. And then with the course, you're going to get the tools and the tricks. So what you must know about assignment risk. Okay, so we'll go through that, what that is, how that works. How about expiration risk, what that is. Auto exercise and assignment, how to forecast your price movement. And then you'll get a trading library so you can go back and review past trades, which always helps me to understand how the trade works. So it's a really high impact, a lot of detail in there. Is your course for rookies? Yeah, David, it is. So you're going to get everything you need to know, and plus you're going to. I like to start the courses out with a lot of kind of detail on the option statistics. Okay, how to use that. So it's really good for somebody that is starting out. So you can learn the statistics, and I go through really slow and easy, and you ask questions as we go. So it'll be very beneficial to you there. So I think, and then it's yours forever. And you're looking at a cost of $197, which you should be able to get back pretty fast, or you can do the alert service and get even additional guidance from me. So yeah, it would be great for somebody starting out. When will the extreme range band be available for TradingView? Do you use anything else but TradingView? So I don't have it for TradingView. I just haven't gotten around to it. I just need to code it. So what are you using now, Greg? That's all you use is TradingView? How many people here use TradingView or Thinkorswim or TradeStation? Just kind of get an idea. Yeah, just TradingView, okay. TradeStation, okay. Thinkorswim, TradingView, Thinkorswim, okay. Wealth charts, yep, I have wealth charts. I've got the indicators for that, okay. Don't have anything for Questrade, no. Yeah, TradingView is good, but I love Thinkorswim, but I've got the indicators for TradingView, but not the extreme range band. Let me make a note too. I need to do that. Hold on here. Hold on a second. I'm just looking back at questions. So question is, do these strategies allow for adjustments if they don't work? Yes, that's a big part of the course, is to show you, the adjustments that you can make, how you can adjust to maybe a butterfly or condors, things like that. And question, do your indicators help with deciding the call or put credit spreads, how to risk manage? And the answer is yes, because the indicators are going to tell you, show you the cycle. Should you, if you're cycling, starting to roll over, that's going to tell you to use calls, or maybe short calls or long puts, or if you're starting to move up, that's going to tell you, what to either short puts or long calls. So yes, it does. The indicators are a great complement, like I said, to any of your trading. So just that alone is worth the 197. So you can go to my website and you'll see the indicators. So I'll show you that in a second. So here's from Charles. He said, thanks for the wonderful credit spread option course. The class was so thorough and expansive on the immense flexibility of credit spreads. Thanks again, Larry, for all the effort you put into your traders. So inspiring to hear an option professional with your vast experience helping others up the ladder to a new level of understanding. So that was really nice from Charles. So with the course, you're going to get these enrollment bonuses. Let me show you the website, what you're going to get as well. If you want to check this out, if you go to my website and you just go to trading software, you'll see all the software that I've developed and offered. So here you're going to get my custom indicators, which are not offered. They have momentum, but when we look here to the extreme range band indicator right here, here's your cycle reversal indicator. You're going to get this as a bonus. So I've got this for Thinkorswim, TradeStation, TradingView, and wealth charts. And so this you'll see here is on the website is 197. Well, you're going to get that as just, a bonus if you do it, if you sign up for the course, and then you're going to get my extreme range bands here as well. So these are, available with Thinkorswim, TradeStation, Ninja. So, I've got multiple different platforms that I've got the indicators for. So if you've got multiple platforms, you get them, for those platforms as well. And so this one is also 197. So you're going to get all this in the course as just a bonus to help you, to navigate and do credit spreads or whatever else you're doing. And then the other thing you'll get here is my course on how to set up your defense targets and profit targets using what I call price target mapping, which is based on Fibonacci and some other things. But these are all the other courses, so you get 60% discount off any of my other trading courses, which are, a lot of stuff. Pretty much everything's option based, earnings courses, all kinds of stuff. So, but you're going to get this price target mapping course as a bonus, which I did back in October. And if you were to sign up and get on the website, it's $397. So just to point out, you're getting a lot of value. And if you're just starting out, it's a great course because you're getting all the tools that you need as well. So yeah, here, Barbara, is the link for the membership with the alert service right here. And we'll go through that here in a second. So again, here are the enrollment bonuses. So you're going to get my cycle reversal indicator. So we have this Thinkorswim TradeStation trading view, okay? And so this is an upper lower study that shows you the reversal, overbought, oversold, and then also shows you the actual signal when there's a reversal. So you'll get that. So basically, it looks like this. Get rid of this here real quick. So anything you want to see or put up, I can do that as well. Another one that's looking good at setting up is GLD. Should have pulled the trigger Friday. So you can see here GLD. So this is a weekly long term. So you can see a cycle reversal there, down she goes. Cycle reversal there, down she goes. Cycle reversal up, up she goes. Up she goes, up she goes. So that's just the cycle reversal without the extreme range bands, but then you're going to get the extreme range bands as well, and those, so you can have those on the same chart or off, add them, whatever you want. So here are the extreme range bands. So here's GLD, and here it is, that same chart with extreme range bands. Cycle reversal weekly, look at that, nailed it. Nail the bottom, look at it, nail the bottom down here. So that's GLD. So that's one that I like the looks of. And the other one, which we saw earlier, was UNG. Another one that's not quite there, but setting up that I talked about, that I meant to talk about, was the bonds TLT. So this is this indicator is such a great indicator for taking tops and bottoms. Here's the weekly long term. So if you look at, take these fib levels off. So these are extreme range bands. So here's TLT. So you can see it came down here. Look how it extended below that 3 ATR. So it got down here to about 113 cycle reversal. See it down here. So the point is, this indicator is 197 for the extreme range bands, and then the cycle reversal indicator is 197. Okay, so you're getting these two indicators just as part of the course. All right, so just a big, huge bonus. I mean, this is going to help any of your trading. So to me, it's kind of a no-brainer to me. I always get no such thing as a no-brainer, but when you look at this tool, it's been really, really good. So you're going to get both those indicators to help your trades. Okay, so that's the one of them. And then you're going to get my extreme range band indicator. Okay, so that's got to upper the lower the bands. And so that's, right here again. Let's take a look. Here's like, here's whatever you want to look at. Google looks It's looking pretty interesting here. So you see Google, see it came down here. That was only to the 2 ATR, but look when it gets, it's never really been to the 3 ATR. But anyway, just to show you kind of example there. So you'll get this indicator. This is available for Thinkorswim, TradeStation, eSignal, Ninja Trader. And I'll look into getting set up for TradingView. And so here's just another, examples. This is your cycle reversal indicator with the extreme range band indicator. This was on QQQ. So rolls over way extended. Right there, there's a signal. There's a signal. And then you're gonna get my price target mapping course. This was a 3+ hour course on how to establish really solid targets for profit or defense triggers. So it's based on using Fibonacci, moving averages, support resistance, standard deviation, and option activity. So it's a combination of all these things together that we use for what I refer to as price target mapping. So you'll get that as a bonus. That's $397 on my website. And then you're going to get a 30-day trial membership. And you can start this whenever you want. You don't have to start it right away. If you want to start it after the course, you can. So with this 30-day trial membership, you are going to get access to the virtual trading room open every day for me, and they're hosting it Monday through Friday, 9:30 to 10:30 Eastern. And then I do a video newsletter update every day after the close. These are archived. Then I do a live Q&A that's recorded usually every Tuesday. I have a Trader's Educational Vault with free trading material, educational stuff there. And then again, there are 60% discounts on anything on my website, software and other courses. So you get all that. So it's really, I think, a great package. So here was one thing I really like. Jay says, reading books is fine, but seeing the actual option trade setup makes a huge difference. Thanks, Jay. So you'll get all that, and then, but you're not finished. So you're going to get, then we're going to do a live follow-up support Q&A. So this will be probably the next day or the next week. We'll send you an email with the link, and this will be live and recorded. And then you get that 30-day trial membership, and hopefully you stay on with us and you renew for each and every month. And then you're going to get another. This is great for anybody beginning or anybody that's been trading options. It's a really nice 60-page option guide with videos that covers the basics of the Greeks and how to use them. Option delta, gamma, vega, theta, implied volatility, how option pricing works. Again, market maker secrets, standard deviation, and option delta probability. So another really great option course to add to your library there. So just trying to, give you everything you need to, get the right support. And then if you'd like to get additional support, then you can have access and do the elite alert service. So 4 months to the trade alerts. That gives you 4 months to the trading club, start, stop whenever you want. So you get access to whatever the market's giving me as far as trade setups. It could be a breakout debit spread, credit spread. It could be a counter diagonal, butterflies, earning trades. So you'll get all that. Here's a little bit of feedback from some members that on the alert services. This from Waleed, who's actually lives in Kuwait. He said, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out alert trades. Some are good, others are not that great. But one thing I've learned and would like people to know on this webinar is to know when I get an alert trade from Larry, I do it blindly as time has shown me that this man is dead accurate in his recommendations. Thank you for your great service, Waleed. And this was from Dan. Said, you're very diligent and totally thorough with your analysis. That is the foundation of the success of your alerts. I paid for my subscription with the first 4 trades I took with you when learning how to trade options. So somebody was kind of starting out as a beginner, so this alert service would really help you on your option side as well. So that's from Dan. So with the alerts, you'll get a, hey, thanks, Sabazar. I don't have interactive brokers. So actually, I looked at, I'm not sure interactive brokers, I can program the code. Anyway, I'll look into it. So you've got Amazon, you've got, hold on, you've got put how to protect this position. You've got, I have 10 Amazon June. Are you long or short puts? I'm not sure what you got on there, Constantino. Okay. So when I send out an alert, you'll get a suggested option trade to use. Some members use it blindly, some just do their own thing. What the entry level is, so you'll have the entry level when it's sent out, the target, when the trade was set up, profit targets based on that price target mapping, what option series to use, your stop loss guidelines will be there. Then, any adjustments that we do, I send those alerts out. I'm, active all day with these alerts. If there's anything that you need to do or any updates to understand what the market's doing on a trade, I'll send those out during the day. So the trades are set up with a video review. I do a video review of the trades, after the close. You get that newsletter every day during the week for the next 4 months. Weekly trading review and Q&A, live and recorded for the next 4 months. Access to trading room for the next 4 months, and discounts on everything, 60 off, and Traders Vault. So all that good stuff. The summary there. Here are a couple of other examples. This is the calendar diagonal alerts. So this is one that we just did recently. You can see the summary of results here going back from when I started this service was back in June of 2019, unaudited, but we've had 193 closed out, 150 wins, 7 break even, 36 losers. High winning percentage there. Here are a couple examples of some that we've done. Here's one we just did, this UNG. This was our super low risk trade. I try to make things as low risk as I can for the members. I'm not just throwing the dice out there and hoping something sticks. So this is one we just set up. This was, natural gas. We saw that reversal going. We've been watching it. This was trading at 868. And then we adjusted this on the 3rd, that was Friday, and we also had some profit on Friday. So we adjusted this, what we call this was a calendar, then we adjusted to a calendar diagonal. And so here's, you can see that when the alerts go out, you can see the text here. It says new UNG long trading 868 weekly cycle low reversal. So kind of giving you an idea of why it was done. So buy the calendar. So this is basically buying, I'll give you a summary of it as well so you understand. So buying the 17 March 9 call, selling the 3 March 9 calls. So that's what we call a calendar, but then did an adjustment here. And so it was trading back up to 928. So here it was, got in 868, now it's 928. So did an adjustment where we ended up rolling the short strike. So we bought to close a 9.5 call, sold to open a 10 call. And so now we currently have 17 March long, 9 call, short the 10 March 10. All right, so we did that. We still have it on. We took some profit, and let me show you what that looked like. So here it was going out. Here it was on Friday, had a little profit take on it. And so you can see where the trade was set up. We got in right here, right there on the 28th. See this momentum's up here. Moving average cross that we like to look at, breaking through this trend line, potential next target up here to 10.5, 10. So we're trying to stick with this trade. This has potential, I think, for a longer term trend. So that's what it looked like going in. And then we did the adjustment Friday and also took some profit Friday. But now we currently have this trade on. So we got a little, we got up to $38 profit, but our risk is $38. So we've got a 100% return. So, any size account can do these trades. So I'm trying to find trades that are low risk that people can get into and feel comfortable with. And that's just a good example of one. And so we're currently in this trade. This has what we want to do in the perfect trading world. We want to keep working this trade to the upside. So the potential for this, I'll show you real quick here. This is UNG, what we currently have on. And what we want to do is adjust this to probably a debit spread or a Condor when we get to that 10 March series coming up. So this has potential to make $68 just from the calendar diagonal on that risk of 38, so 200% return. But what we want to do is adjust this and turn it into probably a long call Condor. So one that I talked about here with you earlier. So that's a look there. Here's another example. This was QQQ, a long put calendar that we did on QQQ. And so I'll go through this. I won't spend too much time, but I just want to show you a few examples. So this one, QQQ, was trading at 303.50. So momentum starting to fade. So we did this one, and so what this one was just the summary here was long the 300 put, the Feb 22, and then short the 17 Feb 300. So it's what we call put calendar. And then we took some profit. It was trading at 300, and it broke down to 294 here. So this one was in and out of this trade pretty fast. Actually, the markets have been moving pretty quick. So went short on the 16th, right here. See this, and then hit down to that moving average support and close that trade out. So this was a pretty much quick in and out. We set the trade up for 120 was the risk, and then it was up to 96, just right there. So some of these are, singles, doubles, and some are home runs. So that was this put calendar. So that would be something that you would see put out. So the total risk on that one was put up was 120. So just kind of flipping through a few of these, kind of give you an idea. Here's another put counter diagonal. This was again on QQQ. So a lot of the short trades, we've been doing these types of structures. And here was one that turned into a home run. So we set this one up here, and we had this big move down. So this was a put counter diagonal that we had set up on the 2nd when it was trading at 267. We did an adjustment on the 4th that pretty much took all the risk out of the trade and then took profit during that time frame as well. So this was a one that we had here, ended up 478. We had right there, it's almost max profit. So it's up over $300. So just kind of some ideas of what you can expect from there. And then here's an idea on the butterflies, just to give you the butterfly service. Started this back in 2019. Had 117 closed out, 88 winners, 6 break even, 23 losers, another 81%. Now, the butterflies will be, and the condors will be the lowest type risk trades. These are typically, at risk maybe 50 to 100, maybe 150 bucks at the most, but you get 2 to 1, sometimes even greater, 10 to 1 on a butterfly. So that's, look there, those are unaudited. Here's one that we did on QQQ. Again, this was back on the 21st. And here was a butterfly setup that was sent out. So basically summarizing it, new QQQ, trading at 297.60. So what we did was we were long the 296 put, short the 290, then long the 284. So we had a butterfly like that for a downside move. And so that was a put butterfly. And this was a profit take around the 22nd and the 24th. So it's moving here. So moved down, and this was that support zone. This is a 200-day moving average. So we were looking for this target here. And so this was, was trading out at 291.96. We set it up when it was 297.60, so up $171, 190% return in 3 days. So going out right there. Here's another one, SPY, another short trade, again, using a long put butterfly. So this was set up here for a move down. So you can see right here, and then broke down, broke that 200-day. So we established that target right there using price target mapping. So it went from it was trading on the entry at 378 and then broke down to 269. So this is another butterfly that we did up 240 on that risk of 115. So that's pretty much everything you'll get. And hey there, Rick. Hey there. So let's see. So you have given different services, trades, and better value. And is there any other level of service than the two you have? No, this is the biggest, the trade alert service is kind of the max service, really. This gives you all the, my alerts plus the indicators. So, that's really the best right now that I have. So just to review one more time, and here's the link. Here's the alert service link. If you'd like to join us, please do. So that's there. And then here's just for the course and all the good bonuses that you will get is this link here. Let me get that into you real quick right here. And if you have any questions, if you need any help, just let us know at support@powercycletrading.com.